Okay, so good morning, everyone. Welcome to today's macro snapshot. For the record, we are Tuesday, February the 13th, 2024. Just want to have a quick look at sort of CPI, a bit of a CPI preview, or just to look at a couple of issues around that. So first of all, guys, let's just actually look and see what's expected and look at the range of expectations. Obviously, as always, we had base effects for the year-over-year effect. So everyone is expecting this to go down. So if we look at the year-over-year number, as you can see, it was 3.4 last month, and we're expecting 2.9. So that's pretty much consensus, and a lot of that's due with technical issues such as base effects. At the base effect, like 1 year ago, the CPI went up a lot. This year, it's expected to go up less. So the base effect will be beneficial. If you also look at the core number, that's expected to drop to 3.7 from 3.9. So overall, for the year-over-year numbers, we're expecting a softer number. Anything other than that would be an unpleasant surprise and unwelcome. But really what the markets are most focused on, obviously, is, and as normal, is the month-over-month number. So let's have a quick look and look at the headline number here. That is expected to drop from 0.3 last month to 0.2. As always, look out for the revisions. So let's just look at the range of expectations here. So I'm just going to look at the economist estimates. And as you can see, the average estimate here, the median is 0.2, average 0.16. And remember, this is for 2 digits, 2 decimal points, so it's rounded up. So really what we're looking at is, this number here, 0.16, rounded up to 0.12. So always a good idea, if possible, if you can hear on Twitter or Live Squawk or whatever your news source is, trying to understand as soon as possible what the sort of the unrounded number is. Because, for example, 0.16 is not the same as 0. What would that be? 2.4, which would also be 0.2. So the point I'm trying to make here is that the unrounded number is important. Okay, so in terms of standard deviation, we have 6/100ths, 0.06. So obviously 0.12 would be 2 standard deviations, 0.18 would be 3 standard deviations, etc., etc. And you can see that a little bit here. You see that 1 standard deviation. Do they actually give you the number here? Let's have a look. No, we have to do the maths ourselves. So that's important to know. Now, just also look at the high and the low estimate. There is a range on the headline number of 0 to 0.3. So obviously 0.3 on the hawkish side, 0 would be extremely dovish. Okay, but really probably the number which is the most important, as always, will be the core number excluding food and energy month over month. Expected to be 0.3. Again, if we look at the estimates here, just what the consensus is here, you look at the low and the high, you can see between 0.1 and 0.4. So 0.1 point, 0.4. The average estimate here is 0.28 unrounded, 0.28, which is leading to the rounded number of 0.3. Standard deviation of 0.05. Okay, so standard deviation of 0.05. So 0.1 would be 1 standard deviation, 0.15, etc., etc. It would be 2 standard deviations. So essentially looking for, late 2, so 0.3, 0.4, of course, would be hawkish. Anything underneath that, the 0.3 number, 0.2, 0.1, of course, would be dovish. Just one thing I just want to have a quick look at, guys, just share with you quickly. Sorry, I think someone's playing the violin next door. Hope you can't hear that. I just want to have a look at that, just compare, just in terms of the narrative. We see here that we have the core PCE, which is the black. And what you can see is that, of course, the core PCE, in theory, is the Fed's preferred measure of inflation. You can see that this black one has come down quite substantially. And that's what has led the Fed to have sort of confidence. And initially, at least, a few months ago, that was leading the market to price in quite a few cuts for the cycle of 2024, 2025. But the problem is that in the blue line here, you have the super core. Now, the super core is important because Powell has been very focused on that. Powell has spoken a lot about that. And essentially, the super core is like the services, core services, but excluding shelter and excluding housing. Okay, so it's because the problem is with the CPI that the housing measures and the shelter measures, they're quite lagging, they're quite slow, they're quite complex. And so Powell basically said that the super core, which is the services, the core services, that's the one which he wants to see coming down more in a broader way. And that's what the Fed has said. One of the Fed speakers yesterday saying that they understand that inflation in general is sort of stabilizing, but they want to see the breadth, the width of the decline in inflation continuing. And one of the problems is that the super core number, this core services number, is kind of stuck around about, just under 4% or so. So really, in order for the Fed to have more confidence, they need to see on the CPI, the super core number, coming down more. So that's something, again, today to be looking out for. And it needs to be what the Fed wants, what Powell wants. They want that to be coming down as much as the PCE number, which we won't get for another couple of weeks, basically. So apart from that, what you should also be looking out for is the shelter number, the housing, the owner equivalent rent, OER, trying to get a sense of whether the whole housing market and rental market is cooling off a little bit. That would be a welcome for the Fed. And also the goods services. So remember that the super core was services. Goods, that has been coming down quite nicely. And the Fed just wants to make sure that that hasn't ticked up more and wants to make sure that that has, stabilized at a lower level or maybe even is going down. So keep an eye on goods, keep an eye on shelter. But really the key thing is going to be the core number overall, but also the super core, which is that sort of services excluding shelter. Okay, so a couple of other things just to keep an eye out for, guys. Just want to look at a couple of things. So as you know, if we actually look and see what, let's have a look and just see what's sort of priced in at the moment. I mean, I went through on the video yesterday a little bit, but what we can see is that at a certain point, the market had been pricing in, up to 7 cuts this year. We can see now if we go here, just using the short-term futures, if we go out to December, so that's the end of 2024, you can see that 4.5 cuts, 4.48 are priced in at the moment. So the market has, taken out some of that excessive dovishness. But what's interesting is that the Fed itself, according to the December dot plot, the December summary of economic projections, I spoke about this yesterday, the Fed themselves are still signaling 3 cuts only. So there's still a bit of a sort of a, as I say in French, a décalage, like a gap between what the market is signaling this year, 4.5 cuts, which would be about 112 basis points. Yeah, there we go, 112 basis points compared to the Fed, which is 75. So as you can see that technically there's still a little bit of a gap. And if we just do the maths, there's about a 37 basis point gap between the official communication of the Fed and what the market is saying. Now, keep in mind that the numbers on this also include a little bit of sort of left tail risk is factored in, and that's why these cuts of 4.5 cuts. It's probably not really 4.5 cuts, because if you're doing the probabilities of these cuts, you need to price in maybe a 6% chance of sort of a 200 basis point cut if there's a huge crazy recession. So just take that with a bit of a pinch of salt. But nonetheless, the market has come towards the Fed, but it's still a little bit rich. And you can see this, let's say, if you look at the SOFR tool on the CME, which I'll take you to here. Let's go to that. So if you look here, guys, what I'm going to show here on the SOFR tool here, which is kind of a nice one, I was talking about this yesterday, is that if we assume that the Fed will take the Fed at their word, let's say they do 3 cuts in this year. So let's say one in, let's exclude the election cycle here, and we'll take that there. We'll have one in December, we'll have one in September, and maybe let's say one in June. And you can see that what I've done is to take out the market pricing, and then we put in 4 for 2025, which is what the Fed has signaled. What I'm going to do here, I want you guys to watch the SOFR pricing. So you can see here that the current is red and the predicted is the blue, and that's where the market is at the moment. So obviously those two overlap. But if I recalculate according to what the Fed is saying, this currently is what the market is pricing. Look what happens down below. Boom. You can see that the current, which is the red one, is higher than the predicted. So if the market comes more towards the Fed, then basically we can see that, contracts, for example, like September in the SOFR, the short-term interest rates, the SOFR September 24 and the SOFR Z or December 24, they're actually about, 20 to 30 basis points too rich. Okay, so you can see the differential. I wonder if it tells us here, Z24. Yeah, so you can see here, it's telling you 37 basis points, and then for U24 is 27 basis points. So you see that here, basically compared to what's priced in, if we use what the Fed is saying, these SOFR contracts are a little bit rich. Now, what does that mean? That means today that if we get a hawkish number, for sure the September and December SOFR contracts have quite a long way to move. And we know that 2 ticks equals 1 basis point. So let's say, for example, the market wants to take out 20 or 30 basis points, or at least go towards that direction. Every basis point represents 2 ticks, which is $12.50 a tick, which is $25 on the SOFR contracts on the future. So that's an interesting one. Now, what about something like the 2-year? So for sure, something like the 2-year yield. The issue here, which is interesting, is that the Fed is saying that they are planning to cut at this point 3 times this year and maybe 4 times 2025, which comes to 175 basis points of cuts. Now, the Fed funds rate at the moment is 533. So the effective Fed funds rate. So if you subtract 175 basis points from 533, you come up with 3.58, 358, which if you look here on the 2-year yield, because we're projecting out towards the end of 2025, that would be down here somewhere, okay, about 3.5. Now, of course, maybe the SOFR rates and the Fed funds rate is going to be a little bit different to the 2-year, maybe 10, 15 basis points difference. But the point is that according to what the Fed is saying, over the next sort of 18-month period, 20-month period, which is about 2 years away, something like that, they are planning to cut 175 basis points, which technically would be, if we just do this, would be, what am I doing here? Would be, I think, yeah, you see it comes all the way down here into the mid 3s. Okay, that's the point I'm trying to say. So what I'm trying to say is that today, if it's a little bit hot, for sure the short end will take the brunt of it, and we probably will get a bear flattening. But maybe the SOFRs will move more than, let's say, something like the 3s and the 5s, or even the 2s. Everything will move. Don't get me wrong. Everything absolutely will sell off if we have a hawkish number. But the point is that the SOFRs will probably need are the ones which are the most richly priced, because as you can see, the 2-year is actually priced at 4.46. So it's already, it's already has come up. About 30 or 40 basis points. If you actually look in the last, 6 days, you can see that it's come up. Let me just grab this. It's come up about 37 basis points. So there has been a bit of a hawkish repricing of the 2-year, is the point I'm making. Now, that's also happened in the SOFRs, but the SOFR contracts have more to go. So what we could expect is, if we get a hawkish number, is the front end in general to sell off a bit more than the back end. That would cause, as I say, a bearish flattening. But I think the ones to hit would be maybe to sell the SOFR September or SOFR December 24, or you could do a spread. You could sell, let's say, the September 24, go long, maybe December 25, something like that. You could do some kind of spread. Now, in terms of the other products, the other instruments, I'd expect gold. Gold's been trading in a bit of a range. I think it would be relatively clear that in a hawkish sort of CPI today, gold would probably retest down here to about the 2009 level. We could expect the equities have been doing quite well, and we all know that equities have made new highs. I don't need you guys to say it. You can see already just having a little bit of a break today. This is the daily chart here, and that's the NASDAQ, and you can see the Russell sort of hanging in there. And that's based, the equities have been doing relatively well based on this idea that, maybe if growth is going up, the real economy can sort of sustain and absorb a slightly higher real rate of interest. Now, historically, that hasn't really been the case. Historically, the equities do not like sort of higher interest rates. There's kind of like a tipping point. So I think what the market is doing at the moment in the equities is to say, okay, earnings have been relatively good. The real economy metrics are doing very, very well. Maybe we could, keep on going higher in the equities, as even if interest rates stay a bit higher, we the real economy, we can absorb this. But the reality is that if we relentlessly get higher interest rates and we get interest rates stay high for long, and inflation comes down, so therefore the effective real rate remains relatively elevated, eventually that's going to grind away at the equity. So I do believe that a higher than expected CPI today could put some pressure on the equities, especially just from a profit taking. I mean, we've had this incredible run up. You see here a little bit of a sort of a hesitation kind of candle yesterday, kind of what's that, a doji, I think. You know, so it could be a little bit of profit taking. It doesn't mean it's going to sell off 20%, but just like a little retracement, you know, 1% or 2% would be absolutely kind of healthy, actually, and not at all unexpected. So that's about it, guys. Now, obviously, on a dovish number, I would expect the front end to rally. So the ZT, the SOFR contracts. The question is, would you buy the SOFR contracts? Now, according to my calculations, they're already quite rich. They're already a little bit rich. So you have to be careful buying something which is a little bit rich. So on a higher than, a lower than expected number, a dovish number, I think rather than buying the SOFR contracts, you might want to buy the 2-year or perhaps possibly even the 5-year, because the 5-year is, the market would be saying, hey, you know, definitely inflation in a year or two, the Fed will be cutting and inflation will be sort of stabilizing. So, you know, even something like the 5 would probably be a pretty good buy, I would say, rather than the SOFR contracts. In terms of the curve, that would imply a bull steepening. So front end yields would come down a lot more in that case than back end yields, which would cause the curve to bull steepen. I expect gold would have a little tick up, and quite possibly the equities, you know, should be quite happy with that, as long as it's not like a crazy deflationary number, in a negative number or something. If we saw 1/10 below expectations, I suspect that the equities would find no reason for that to be an unpleasant surprise. Okay, guys, so I'm going to leave it there. Hopefully that was useful. We'll keep on talking. Good luck. And obviously, as always, let the algos do what the algos will do for the first 10 or 20 seconds. Consider everything. Thanks very much, and we'll talk again soon. Thank you.